Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, November 14th, 2025. We're recording this at noon Eastern Daylight Time. So here's your starting lineup. Macro market thoughts. We're in a modest November correction. We'll dig deeper into that and give you our thoughts. Number 2, NFIB Small Business optimism. It falls to a 7-month low, just about the only piece of data we got this week. And number 3, CoreWeave. Arguably the most exciting IPO of the year. They reported the quarter. Very interesting conference call, so we'll dig into that. So back to the macro markets. The S&P 500 and the NASDAQ 100 peaked at all-time highs on October 29th. They're now down 4% and 6% respectively. Artificial intelligence hopes have turned into fears over excessive CapEx, worries about job losses, worries about too much energy burn, on and on. There are also fears over the Fed passing on a rate cut at their December 10th meeting. There are worries about the economy slowing down, a weakening labor market, the lack of data. All of these things, I think, are weighing on the equity market. However, it is unusual for November to be down, especially in a good year like 2025. And November, at the time of recording here, November is down about 1.6%, making it the worst November since 2008 if the month were to end right now. But we see this as a healthy, really a rotational correction. Remember, the Dow Jones Industrial Average made a new high this week, I think on Wednesday. A new all-time high. The Dow has different components than the S&P and the NASDAQ 100, which are dominated by technology stocks. So sentiment has cooled off. It's back into what I would call neutral territory. But for technology stocks, it's probably gotten pretty pessimistic. For AI stocks, for quantum stocks. Listen to some of these figures. Meta, one of the Magnificent Seven, down 25%. In the last month. Oracle down 40% over the last 6 weeks. CoreWeave, a stock we'll feature later on in the pod, down 60% from its summer highs. Rigetti, a big quantum computing stock, down 60%. And Dell, just kind of a run-of-the-mill second, third derivative AI play, down 23%. So there's a lot of pain in tech right now in certain companies. The wall of worry out in the marketplace is massive. I would call it a Mount Everest of worry. Here are some of the things that just come to mind that are concerning investors right now. Weakness in the low-end consumer, political dysfunction, intractable deficits as far as the eye can see. Tariffs, are they legal? Are they impacting inflation? Affordability, a new word that the Democrats introduced to us in the election last week, a big focus. Is the administration going to pivot? It looks like they are. Labor market weakness. AI going from hopes to fears. Concerns over Fed independence. Concerns over high valuation. Like I said, a Mount Everest of worry. But bull markets climb walls of worry, and we think this remains a bull market for stocks. Emerging market equities and the MSCI All Country World Index are our 2 favorites into year-end and into 2026. We continue to think, as we have all year, that international equities are going to beat the S&P, and we think they're poised to continue to outperform the S&P 500 in 2026 as they have all year long. So on to number 2, NFIB. We remain in a data desert due to this government shutdown, which thankfully has ended, but the data desert continues until they can start to get the mills running again. I like to focus on the NFIB Small Business report because Small business drives the American economy. 2/3 of American workers work for small businesses. Small business is also a key part of the Trump coalition. So I watch it for that reason. The NFIB headline survey declined 0.6 points in October to a weaker than expected 98.2. That's a 7-month low. This survey popped very hard this time last year on the president's election, and about half those gains have been erased. So I don't want to overdramatize. This was not a really bad report, but what's beautiful about NFIB is they give us lots of sub-indices where we can really look and see everything from employment to pricing to expectations. And expectations dropped to the second lowest in a year, surpassed only by Liberation Day to the downside. And half of NFIB components dropped in October, with a sizable drop in earnings and sales expectations. NFIB wage and job indicators reflect a loosening labor market, which is a theme that's gone on for months now. And small businesses look to be having trouble passing along price increases. They're going to keep trying, but it's not easy right now to pass along price increases. Now on to our third topic, CoreWeave. This may be the highest leveraged way to play the AI boom. It's a direct CapEx and direct compute demand play. They told us in this conference call this week that they are in a highly supply-constrained environment where demand far exceeds supply. That's one of the most bullish things I think I've heard management say in a long time. Third quarter revenues were $1.4 billion. That's up 134% year over year. And they threw out a number of $55 billion of future revenue backlog that's up fourfold year to date. I thought they did a really good job of reducing customer concentration. At the beginning of the year, one customer is 85%. Now that customer is only 35% of the backlog. And they signed large compute contracts with Meta and OpenAI in the quarter. This company is striving to be the cloud platform where major AI companies run their workloads. That's what they're working toward, and that's what all the CapEx is going toward. In listening to this call, this may be the most exciting and outright promotional call I have ever experienced. This is a very aggressive company, and I think that's both good and bad. But this reminds me of Larry Ellison and Oracle back in the early 1990s, when they were very aggressive. Larry would be very bullish on the conference calls. And consequently, the stock had a lot of volatility, and I think that's exactly what is going to take place here with CoreWeave. So the stock went down on the numbers due to, I think, mostly a delay in data center build-outs. They talked about shortages. They talked about bottlenecks. There's so much money going into this space, and there's so much competition for materials, for workers, for supplies, just to get these shells built. And while CoreWeave did generate an operating profit of around $700 million in the quarter on an operating margin of 16%, make no mistake, this company is not making money in the traditional sense. They aren't going to show net profits until 2027 or 2028, according to the analyst models. I went in and I dug into the analyst models, and I found that out. And they use what they call adjusted diluted EPS, which is certainly non-GAAP EPS, as what they guide people toward. But interestingly, there's no free cash flow for this company, according to the analysts, until 2029. So this is a highly levered, high-pressure way to play AI, and I just think it's going to be really, really volatile. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.